Okay, this is a private equity case or test. All right, now they had a fancy little name in their test. I renamed it Dr. Evil because if you want to get a job with one of these people, not nice people, I don't think. Here is that we have to finish this in 1.5 hours now. Let's see. Now I'm going to be stressed. Let's call it 9:10. Okay. So that would be 10:10 and 10:40. Okay. Let's see if we can do this. And it wasn't really a port, but I changed the names because I don't want them to sue me and all this. And then we have a transaction date. This is not and we're going to do it for a 20-year period. Don't get too fancy. We just don't change the period or anything else. And then we have some traffic assumptions, and they have 1% growth. Everything depends on growth, and that's the depressing part of life right now. So we're going to spew more stuff into the atmosphere. And then not only that, you're going to grow in 2% real terms. Unbelievable kind of assumptions. And if they depend on their IRR, depends on this kind of stuff, okay, well, maybe. And then they're going to also grow by inflation. So you got three parts of the revenue growth. Operating expenses are going to go down. So they're going to fire everybody. And then we've got CapEx as a percent of revenues, an idiotic assumption and a really important assumption. So if we had lower revenues from inflation, from real growth, we get lower CapEx. Maybe that's okay, but that's a ridiculous thing. Okay, and then we have inflation assumption, simple, and then we have a 15-year depreciation taxes. But the good news is we don't depreciate new capex because then we'd have to put in retirements and it would be a pain. And then, unlike a project finance, we have a sources and uses, but they say that you get an EV based on a target IRR, but the target IRR is the equity IRR. That's all they care about is equity IRR. And we need to back into the target IRR based on the equity IRR. Of course, they put in fees, and then we have to make sure we have this in millions or thousands and all that stuff, and we don't get confused by that. And we have some debt arrangement fees, and we have to pay off the debt, and then we have some drawdowns, and we're going to have a debt to EBITDA ratio, and we have some base interest rates and some margins, and then we have a cash sweep. So they made it a little more complicated with a cash sweep and with a refinancing. It's a little bit intimidating, okay, with all of this stuff if you just read it. And then they have a terminal value, which is really related to not the financing. So they, of course, got that all screwed up. You're supposed to make a cash flow statement. And they say on the output sheet, screw them on this one. Screw them. I'm not going to put that in there. Okay, I'm sorry. We can move it later on. Oh, Jesus. And then we want I'll show you why. We want an EV to equity bridge loan, which means the enterprise value minus the net debt gives you the equity value. And we'll do a little summary of our sources and uses and our transaction. A sensitivity table based on the input IRR, which is going to be a pain, and the exit multiple if you really want to do that right. Oh, those assholes. Because we can just put different IRRs in for the enterprise value. We'll show you and do something there. And then the equity yield, which they call the annual payment to the equity, which is the dividends, divided by the equity injection, a meaningless number. But we'll compute that for them and some DSCRs and then graph this yield and graph the closing balance of the debt for some reason. Okay, fine. Let's do all of that. And so what they did is they gave you some inputs. Now I've changed these inputs around. I've used my generic macros to do that. And I've already wasted 4 minutes by giving you a little introduction, and you have to read the case anyway, okay? So that's going to take some time, and then they have the acquisition date, 20 years. the equity IRR, the exit multiple, at least they put that up at the front here, and inflation rate, and some revenues, and all those inflations, and then all the debt assumptions. So the good news is we don't have to waste time getting the assumptions into our sheet this time. And then they gave just a little bit of things at the top. I don't know. I assume that they gave us that. Now, when you do this, they put the year count and they started it here and then they did +1, fine, whatever. And now let's do a couple of things. Let's put a transaction period here, okay? Now I'm using this and the transaction period. If we want, let's be a little fancier. Let's start putting all of this stuff in. Hang on, we gotta put some. We gotta put some flags in, and we can put some year and some date. So do this. That might take a tiny little. That might take a tiny little bit of time, but you want to show that you're organized. And then in column F, don't make it small like these idiot private equity people, and make a couple of extra columns because we're going to read the stuff in. So when we read the transaction period in, let's just get our period, and we're going to go down step by step. And then we press Shift Control 3, and you got to get fast at Excel. And don't think you're good from a university class because they don't teach you shit in there. Sorry. And then you press Shift Control B and Shift Control R. And we got some funny colors. And then let's put a terminal period. Okay, we're going to certainly need that. And we're also going to need an operating period. So for the terminal period, let's just put another flag and get that from our model. So I'm trying to go quickly, purposely here, and you should try that and put an equal sign, go up to this one and put an equal to this one. And then if you're not using if you're putting a little if statement, you've just wasted a whole bunch of time. Sorry about it. Whoops, it really pisses me off. Sorry about that. And then put an operating period and put another flag for that, Control D, and operating period, we don't need anything, and it's just not the transaction period. Okay, we're going to need that. You're always going to need something like that. Okay, and then if you don't like this kind of how it works, you press Control Alt C, and I'm wasting a little time, but I don't care about that. I do now, because it's taking too long. Shit. Okay, I don't care. I'm going to waste time. This investment in time is worth it. Okay. And then let's reset the format. And after we reset the format, let's not put a thing in the top and not put a sum function in here. And let's just color the sheet. And what we're going to do is keep this. Oh, damn. Okay. I don't care. Okay, finally. Okay, and it gives different colors for when we have a true and a false, and you want to impress people, and it's got the terminal value, and it shouldn't have taken anywhere that long, and it gave you a little bit of a different color when we're reading it in from a different sheet. Okay, we're going to do that quickly. And then we're going to start with our, up here in column B, let's start with our operations. Let's start with, let's start with our volumes. And don't be chintzy about the numbers. That's FAST. Be transparent. Put the base volumes, and then you can start. You know you're going to have a inflation escalation or a volume index. And then we can put applied volumes. And I'm just, because that's all we have, I'm gonna call this operations. And there's gonna be, when we use our little generic macros, we're gonna have this, so the base volumes are tons, and we go and we get the tons. And you try to do this kind of crap fast. Here we've got that, and then I'm going to press Shift Control W on this, and I've got to make it a little bit wider, and we're not going to be idiotic. And now when we put the volumes in this time, we're going to keep them and Shift Control R and get this really done fast. And then we're going to put a index in next, and we're just going to put the volume index in, and we're going to do something like that. And they want to see this, and they said we got to be really careful. The volumes increase after the first period, so they only increase after this. Now what you can do is you keep this one as a special little column and multiply that by 1 plus, and lock that and multiply it by the operating period. That makes sure it, and Shift Control Q and Shift Control R. That makes sure it doesn't do it. And we'll put tons, and maybe this should be tons, and we've got a nice layout. So you've already shown people that you're pretty good, because you can lay things out carefully. And then let's put the price. Okay, and we can put the base price, and then index for real price, and index for inflation. Now the inflation, we'll use that for the operating cost too, but we can kind of cheat. So the real price, we'll put, I don't have a euro sign on my computer properly, because they put this in euros, and where is our price per ton in real terms in 2022? Shift Control Q. And even though they would probably not be used to you doing this, just copy this across. And of course, I did it wrong, but that doesn't matter. We'll just put it down here. Okay, and then we'll put our index in here, and then we'll put an equal sign and go down and get our revenue. This is our real price increase, which is absurd, which for a real price is completely absurd, but we're going to do exactly the same thing. If we were fancier, maybe this time I'm going to multiply it by 1 plus, just in case we have another index, let's put the F3, F4 over here, and let's put the F4 over here a few times, okay, and let's press Shift Control Q, Shift Control R. That's our thing, and then we'll put our index for inflation, Control D, and then we'll put our inflation rate. Now that's a pretty high inflation rate. You should really look at that. I press Control D, and hopefully we can just do this. Okay, so now we can put our applied price as this, and we haven't wasted much time, and we have shown people that we can compute this effectively and transparently, and then we can put the revenues. Okay, and I suppose, and notice that these revenues are in euro, and when they have thousands or millions and all that, we're going to have to make some adjustments, because let's keep them all in euros. Don't do the idiotic thing which my client just did, and then if you get something like this, Control space bar, make it a little wide. Okay, and if you want to be fancy, Shift Control right arrow a couple of times, Shift Control E. Okay, there's our revenues, and then let's put our operating expenses You know, we could have done this. No. Yeah. I was going to indent them. Let's not bother, okay? Because that would be a waste of time. And we'll put base, operating expense, and we'll put index for real growth, index for inflation, and finally applied. Okay, and you're always going to have to do that. And we've got enough. So let's see, how did they put their operating expenses in? There's idiots. They put it in thousands of euros. Okay, fine. But if you're going to do that, then so let's put let's put this in euro again. And this time I'm going to kind of cheat because I'm not directly taking this, but I'm going to multiply this by 1,000 or 1e to the third. Okay? And shift control W. So be careful with the thing. So let's just fix these and go all the way across. And then let's put a couple of indices. Which, again, if they really do this kind of stuff where they make these ridiculous assumptions about expenses going down while revenues go up and all that stuff, that no wonder they can make these investments and claim they're getting a high return. And I shouldn't waste your time by saying that. Let's copy. That don't worry about that. Copy that down, and Control D again. Here's I got my computer on the I think we're okay. Okay, Control D, and then we've got this, but we've got to put our assumptions in here, and for the real growth they had -2%. Good for you. And then they had, maybe they just want to show how you can whatever, that you can apply that to a negative number. Okay, and the good news is we've started to get all of this stuff in, and even if you would stop here, I would argue that you've shown them something. You'd say, oh, I didn't know that you could do all of this so fast. And so we can do that. And then the next thing, almost always, there is some good news here. And that is that they did not do something silly by putting a bunch of other random expenses. Let's put EBITDA. I mean, working capital. They could have really tried to waste our time with that. Okay, and so let's get that done. And here, let's just put, this is such an important number and should be kind of the place to start. What did I just do? Oh no! Oh shoot! We have the real price. Was the tons in thousands? Oh, see, I already where tons. They just said those tons are. I'm gonna have to make them. I'm gonna have to change that assumption. That's what they had, but what's going on? Crap. They said this was, the inputs were in tons. We had 4 million times 5. 4 times 5 is whatever, 20 million. And then they had this that's in numbers, and they were all there, and then they had the costs per ton of volume. and I used the wrong thing. This was the cost per ton. Okay, I already screwed up. Let's just put that down here. I'm so sorry. Okay, and so oh my gosh, look at me. Okay, and so we have here we have the cost per ton. Sorry, now I'm really nervous. Applied, and I guess that's good. And then let's put the operating expenses. Okay, I guess. Now, am I psychologically going to get all worked up about this now? And if I make a mistake, I'm sorry. That's life. Okay, so we multiply that by our volumes. Okay, oops, and Shift Control W so you can see what's going on. And then let's get our EBITDA. So very good. In a way, I'm lying, but I'm a little bit happy we can make this mistake, and then I'm just pressing F11 to look at that. So if you want, you can make a graph of these little things. Okay, so that's our EBITDA. Now, once we've got the EBITDA, let's put the terminal value in. And that was, I hope it's a percent of EBITDA. And the good news is we're starting to get somewhere, okay? And after that, so we've gone through the costs. We're going to have to put the CapEx in, and then we're going to do a little bit of depreciation and get our taxes, and then we'll be into the thing. So let's put that in, and again, do everything in euros. See, oh well. I don't know. Was that really bad? I'm freaked out by making that mistake. But Shift Control Q, multiply this F4, multiply that by our EBITDA, and multiply that by our terminal period. Okay. Shift Control W, Shift Control R. If you don't use this, and here, what happened here? What's going on? We don't. I'm gonna. Everything occurs at the end, so we can make this the last period, and they closed off the sheet in the wrong thing for us. Okay, and so now what we can do now is compute our do we have no? We need our depreciation on our capex and our taxes. So we'll put on going cap X, and that let's put why don't we do that percent of revenue, a percent. Yeah, they did it as a percent of revenue. Okay, whatever. And I suppose we might as well do it even in the first year. Multiply that by the revenues. Okay. And okay, and then we can put in our depreciation. And to put in our depreciation, how about let's put depreciation and taxes. And go again slowly. Depreciation base. We're not going to add our own ongoing capex to that. And then we'll put our depreciation rate. Oh, come on. And then we'll put a depreciation flag because we only got it over 15 years. And then we'll put our depreciation expense, which is in euros again. And then after we put all of our stuff in here, then we can put our EBITDA. We can even replace that less less depreciation, and we can compute our EBIT and put taxes. Let's call them operating taxes. And once we have the operating taxes, let's put our free cash flow and then start with our EBITDA less capex less operating taxes less and we don't have any working capital, so we can call that FCFF if we want to be fancy. And then we can put I'm not going to call it WACC. Let's put target project. Now this is going to be the big thing. This is the whole trick of the whole thing. And then you can put your enterprise value. Now I'm not going to, and then sorry about this. We have to add the terminal value. And if we wanted to write an assumption in here, we'll put no taxes. So we'll not compute a gain on the sale of this or anything else. We just have to put that in, that we assume that when we sell it, we're not going to pay taxes on it, okay? Or the EV to EBITDA kind of has that in. So once we put a project IRR in here, let's just put, let's say that's 7%. Then we're going to eventually change this to a goal seek, change this IRR so that we get a equity IRR that we want eventually. And to get that, it's just, this is the NPV at target IRR. So let's get this part done. Okay, again, try to go quickly. We're okay. I've got till 10:40. I've got an hour, and we're totally fine. I hope this time. This is euro, and this is a how about a percent, and this is a flag, and let's get our base for our depreciation. So we've got this thing that I did, but again, multiply that by 1,000 because keep the units. Nice. Now you could cap that later, but let's do it in a simpler way. And this is going to be 1 divided by our 15-year life. Okay, and put that one in. F4, just continue it. Notice that you really want to go fast, and let's put our 15 years in. Okay, and the good news is, and just make this, I think we can do this. Yeah, this one we had a little counter, make this one less than or equal to this. F4, Shift Control B, Shift Control R. We're going to color the whole thing later. Don't worry, of course, about that. And now we'll just take our base for our depreciation, multiply it by the depreciation rate, multiply it by the flag, and we get our total depreciation expense. How about another little line here? And it ended in year 15 like we wanted it to. And then let's get our taxes. So we have our EBITDA first, and we take away our depreciation next. Oof, we're going to have negative taxes there. Okay. I hope we don't in the next period. And then we got we put our so these are euros. Did I? This is Shift Control F. Okay, and let's put our tax rate here, and maybe I made some kind of screwed up. I don't think I did. Let's put F4. Let's press Shift Control W on all of this, and good. We have some positive taxes in the next periods, so it's really gonna. And then once we stop our depreciation shield, that's going to affect all of our free cash flow. And for our free cash flow, let's get our EBITDA again. That's the key number. Let's take away those ongoing capex we had. Let's take away the operating taxes we have, and let's add in the terminal value and keep it all nice and very, very clear when you're doing this. Shift Control R, and again, I'm going to waste my time with these units, but I just wasted a minute. I did waste a minute. Come on. Okay. Oh no. What a waste of time. This is what you don't want to do. Oh no, I'm crying. Now, when you finally compute this one, should we have? Okay, these idiots, they like to not use the positive number convention. So let's put these as negatives so we can do our alternate equal and just get a sum, Shift Control R, and then we can get this. Now, when we do this, we have to be a little bit careful because I only want to do this if it's the operating period. And there's a little trick here. If you leave it as false, then it's the NPV formula is not going to be computed. So then we can put the NPV at our terminal value of this, and I'm not over the terminal value of this. That's our enterprise value. And you want to show people you can do the whole free cash flow business. And then we listen to Modigliani and mainly Merton Miller, my hero. I shook his hand like I told you a million times. And we separate the financing from the operations. And when you do the financing, begin with sources and uses, but call it uses and sources. And you have the enterprise value. So let's put the enterprise value. Now that's going to change. The whole business, the whole trick of this thing is to. Can I do this? Yes. Ugh. The whole thing is gonna be that you and put this stuff F4, multiply it by the transaction period, which was up here, not any other period. You've got to keep that separate. It's like in a project finance, keeping the capex period, and then you can add the what fees did we call it? Fees. Let's see what we called those. Up here, there was some advisory fees, of course. We should put that as part of it depends who they're paid by, but let's get that. But again, this one was in thousands, so you don't forget that thing, okay? All right, it's not that big a deal. Okay, and then we don't know the next thing yet, but don't worry about that. We'll add the debt fees. Now they were really jerks about this because they made you depreciate the debt fees and all that stuff. But what I suggest is not wasting too much time on this until you get to the kind of the end. So they have an existing debt multiple, they have an exit multiple, we've got the inflation rate in here, and they have the amount. I'm going to put this to 5 on the EV to EBITDA ratio. They have a tenor of 5 years, and they have an arrangement fee of 1.5%. So I would just go and get that arrangement fee here, and that can cause a circular reference, but I don't think it will on this simple case. And we let's not fill that in because we're going to multiply that by the debt down below, and then we have to add in the repayment of existing debt. Okay, and put that, and so go back to our inputs. And up here, oh, we're getting all, the good news is we're getting all this kind of stuff already done. And that's a debt to EBITDA. So you go up here and get the EBITDA. Maybe we should always get it from the same place. Maybe they'll comment on that and multiply that by the F4. Multiply that by the EBITDA upstairs. Okay, and of course multiply that by the. Come on. Multiply that by the transaction period, and make sure you don't have an ancient computer that you've spilt all your coffee and beer on and everything else like I have. And then we'll put total uses of funds. Now, you know that I am a really old man, and if an old man can do this, you can do this too. Now, if I press Alt equal, it didn't really work, so I'm going to do it by hand and not waste too much time on it. And now we've got the sources and the uses of funds. Maybe we should have kind of put uses, and let's put, maybe I'll just, for now, just put it like this. And then let's put sources. And for the sources, we have our debt issue, and equity issue. And that's about all they have, I think. I don't think they had anything else. And for the debt issue, they said, well, our original debt is going to be issued at 5 times EV to EBITDA. Okay, and so let's multiply that. And that's why we put our faults in for the future one, but we still need all that stuff in the original thing, and I didn't multiply it by the transaction period, which was so important. And then the big deal is the equity is the total minus the debt. Now, I'm a little bit worried. No, I'm not, because now we can fill this in, F4 times the debt issue down here. Do I just, oh, I know what I did. Shift Control W, and I was just looking at it. So what you should do is you should look at your stuff here, because I didn't press Shift Control W to get this. Yes, I did. Now this is crazy. There's something wrong. The enterprise value is this, and our, did I multiply our EBITDA is 13 million. I multiplied it by that, and maybe, did I do something wrong with the this, and we got a big terminal value, and we're getting way too much equity compared to the debt. I'm going to continue. I wonder what there's something that makes no sense that we have so little debt here. What did I do wrong? We pay taxes, and we're doing this. Let's put a 11% discount rate in here for now. Then it still is not much debt compared to all the equity, and I can't see now. This is the kind of stuff that would drive me crazy because I can't see mistakes we have made. And okay. It's just that the enterprise value looks very high. What if we put 20% here? Oh, sorry. You know, then we get. I'm gonna leave that. I'm gonna leave it crazy. Okay. Whew. I really wonder what I did wrong. Okay. But let's keep going. Now, after you've put the sources and uses in, you want to put the characteristics of both debt issues in. So let's put the acquisition debt facility, and let's first put the repayment period. I don't care what kind of thing you have, you're going to have a repayment period. You notice I just kept going because I'm really struggling with why the debt was so little compared to the equity. We repaid this. So our new debt issue is this, and it all must be something, and I can't see the mistake I've made. Okay. And then just keep going. I suppose my advice is just to keep going. And we only had a 5-year debt, okay? And then they started being a little bit difficult with us here, okay? So let's put, it's got to be the operating period and this a year is less than or equal to, let's put less than or equal to 5, okay? And Shift Control B, Shift Control R, okay? And after we put the repayment period in, we're going to have let's just put all the stuff in. Let's put the interest rate. How about we'll put a base interest rate. Let's just put all of that stuff in. We really should. We've got the tenor, we've got the size, and we've got the interest rate. That's what we need. And this is percent, and if you're fancy, you put PA, and let's get our base interest rate in. Okay. We'll start to do this, and then, oops, that was an idiotic thing to do. This is just going to be flat, so don't bother. You could multiply it by some flag or something like that, but why bother? And let's put the credit spread, and you can call that the credit margin, and that's the same kind of unit, but this time we get a credit spread that changes based on the year. And so they wanted you to do that. What I would suggest doing is put equal lookup, and then you go up to the operating period, which is a nice thing that has the year in it, and then you click on the year, and then you click on the margin. And you better not use VLOOKUP or HLOOKUP or anything like that. And then you've got that in, but what just happened? Why did it keep it? And did I meant to put this year in, of course. Good, we're checking our work a little bit. Okay, and then you can put the total interest rate. Now, if you hear these idiots at my apartment complex they're screwing up the environment with their stupid little chipper things. Let's just add these together. I really get pissed off. Okay, we don't really care about the interest rate in the first year, and then we've got our credit spread, and it's going up, and good, and we really don't care about it after this period. Okay, and then we have our cash sweep percent. And you know what I didn't do? I should have done this. I can't believe I forgot to do this. We should be putting sums here. You know, and if you want to do this really fast, I think you can press Shift Control V. Let's get a sum of at least a sum of the revenues and a sum of the operating expenses. Shift Control F and Shift Control V. Let's get a sum of the EBITDA. So we've got all of this EBITDA, and we've got this CapEx much less than the EBITDA. Did I put the CapEx in wrong? No, it was 5% of the revenues. And then we can do the rest of it, but let's just keep going. So you just want to show you should do the sums, okay? And for the cash sweep percent, the reason I'm doing that better add up to, let's see what it adds up to. Let's use another lookup. This time, again, unlike the last time, go up to that lookup thing and put the year and the cash sweep. And we've got everything modeled except for our refinancing facility. Okay, and we're not really ready to model this, but I would, where did we put the sum? I would put a little up here sum, and this is constant. And oh no, I screwed it up. Oh, shoot. Let's move this over to here. Oh, fuck. What a waste of time I just did. But whatever, okay? That's not really the sum, so whatever. I'm going to leave that. That's good enough. I've shown you what to do, okay? And for the cash sweep, let's press Shift Control V. And we better, this time I'm going to multiply it by the repayment period, okay? And what is this? Did they give us 100% in year 5? Well, I was wrong. That doesn't make any sense. That's a percentage of the cash flow, okay? So that was kind of bad. Okay, I made a mistake there. And now let's do the same sort of thing. How about for our finance facility? Now, the first thing is, let's put the debt size or parameter. Okay, and this is times. We're going to, so the good news is, as soon as we finished with this, everything will be modeled. Okay, and let's put the refinance period. Okay, and that's going to be a flag. So we want to show people that we're good at this, and we're going to refinance it in the year 5. Okay, and then we're going to put in the base rates, and this time we're going to have a flat repayment, and we're also going to have a arrangement fee. Okay, so let's for now let's just get this in. Let's put a F4 equal this year up here. Okay, Shift Control B, Shift Control R. Okay, and I didn't spell refinance period, and I'm going to leave it there. Okay, and then let's put how about let's put here year after repayment. Okay, and let's put a counter. We'll just this one plus this one. No, this one plus this one. No, let's put post let's put refinance repayment. Let's just put another flag here. I'm losing it a little bit, but not that bad. That starts in again year 5, and just put that. This is going to be this number up here greater than, not equal, but greater than this number. Oops. Shift Control B, Shift Control R. So now we have a little counter, and the name, bien sûr, wasn't very good. And then let's put repayment counter, and put a counter here, and just put an equal sign, go back one, and add this. Okay, so now we have that we're starting to repay here, and we have a little counter because we need that counter, and then let's finally put repayment. What's going on? What happened here? I'm really freaked out by the by the EV to EBITDA stuff, and let's put this is going to be another flag, and this is going to be, and we put that we had a tenor here of 15 years, okay, and we just put equal, this number is less than, or we'll put and this is a little trick you can do, I think. And this number is not equal to 0, and this number is less than or equal to 15. Okay, that was a little bit tricky. Shift Control B, Shift Control R. Let's Shift Control V. We got it right. We have a little bit of flag. Oh no. Oh, I guess this goes all the way to the end. I didn't realize that. Maybe we didn't have to do all of that. That's okay. I still have 40 minutes left, and we're almost finished with all the inputs. And then we're just going to have to finish up the equity cash flow and do a couple of other outputs. So we got the tenor, the refinancing. Let's get the margin and the base rate, and let's cheat on this one because no, we can put it in. We put base interest rate, credit, spread. Okay, and they're all a percent P dot A. Okay, and we put this in, and I'm just so freaked out about okay, I'm so freaked out about that really high EV to EBITDA. I mean the EV ratio, okay? Okay, and let's just do something simple, okay? And this time, for once, let's go total interest rate. If you really wanted to waste time, you could say, oh no, what we got to do is we got to multiply this by some kind of flag. We could multiply by the repayment flag, but what a big waste of time. And then let's put repayment percent. And I can't believe these people with their waste lookup. Okay, and let's look up on the repayment counter this time and get this. I didn't do it like that. Sorry, it's even easier. Maybe we didn't even need all of that stuff, but whatever. But we put it in this year. They put it by the year, so they kind of gave you a little bit of a cheating way to do it. Okay, and oops, and then let's go over here and make this. I'm going to cheat and make that. No, I can't do that. I got to put a 0 here. Okay, and then we get this, and this time, finally, we can do a sum. Oh, shoot. What's going on here? We started in year 5. We went to year, what's this 47.5 thing? 15. This, no, I was wrong. It's from year 6 to year 15. So this one, we were absolutely right. This one, we start, okay, I guess we have to do this. We start with year 6, and we go to year 15, and, 9, 10, 11, 12, 13, 14, 15. Shoot. Does this sums to 100, and we from year 6 to year 15. Sorry about this. So we got from year 6, and we go all the way here to year 15. And then our payment flag is all messed up. This one should be, oh shoot. They screwed the whole thing up. The tenor is not 15. This is 1, 2, 3. Oh, these assholes. The tenor is not 15. The tenor is 10. We got to fix this, you idiots. We didn't do anything wrong. It's them who did it all wrong. And then, so now we got to multiply this, and it's good we did our little check here. Oh, the fuckers. Sorry I said that, but you're allowed to swear if you're swearing to yourself. Okay, and then we better put a little check to make sure it really got you the repayment. That's an illustration of the importance of doing the sum. And then we have an arrangement fee. I can't believe it. Those jerks just screw you up. Okay, and I don't know why I put it twice here. And we can make this arrangement fee, this thing, F4 times the refinance period. That's when we're going to have to pay it. And then, you know what we should have done is put this debt size parameter, that was a stupid thing to call it. Let's call it what it is, debt to EBITDA. And it's going to be 5 times, and we're going to have this 5, and we're going to multiply this by the refinance period. And I hope you see, it's so important to get all these flags in here. So we start with this, and then we repay the debt, and then we have interest on the debt. So we're almost ready to put all of this stuff in now. And the next thing to do is let's put a whole section with debt. Let's put a whole section with debt balances. I just looked at the time. I don't know how you do this. We can add the draw less the repayment scheduled. And what I would do is put the another flag here because we have a cash sweep, so we got to put the final repayments flag, and just put the flags there. Don't be these horrible things, and then you put closing balance. I can't believe these people. And then you can put your interest from the interest rate. Okay, and then and this is this is our acquisition. And we didn't put the one in for the less cash sweep. Okay, and we've got all of this stuff, and it's all in. And okay, and then this is in euros too. And then, you know, could we put these here? Ah, come on. Ah, good. I'm going to make it a little wider even. Okay, and let's do the same thing here. In the second one, we don't have any we don't have any cash sweep. We can leave it there just to show that we're good, and we don't really need this repayment flag because we have the maturities. And once we've done this, once we have this debt balance, let's put a cash flow, and that's why they're so asinine for. And let's put EBITDA, which we get, add the how about less the capex. Then let's put add the terminal value. Now, then we'll put less taxes paid. But the taxes paid are going to have to be a little bit different. And to get this, let's make another little thing here where we go. Look, it's taking a little tiny bit of time. And to get the taxes paid, we do the same thing. We put EBITDA less depreciation. I'm taking a test. Don't bother me. I'm just joking. Yes. I'm making a video. Okay, and then we have to put less interest here. Okay, we get to deduct the interest, and then we can put less amortization of fees because they made us do this crap. And then we'll put, did I miss anything? EBT. That's not really EBITDA anymore. And then we put taxes paid. Okay, and let's just see where we're going. Let's just, maybe I should have put this over here. Okay. Now, once we have all of that, the taxes paid, less blah blah blah, less tax. Let's call that operating cash. It's not really. You could put financing cash flow, but I think this is totally fine. How about less interest on acquisition facility, less interest on the refinancing, and we could put less repayment of whatever of refinancing, and then we could put add the new refinancing, and now we need the EBITDA to get that, and then we can put and then we can put less repayment of acquisition scheduled. That will be at the final period, and then after we've done all that, that gives us the cash flow before sweep. And if you wanted to do it a little bit differently with the way you arrange the acquisition and all that, that's totally fine. And then we put down here the cash sweep. Now they want you to compute DSCR with a cash sweep, which is kind of a really stupid thing to do. And then after we put the cash sweep in there, which is, that percentage we had times the cash flow before the sweep, then you can put net cash flow, and we're allowed to pay that as dividends. And then once you have that, let's put our equity cash flow in. And then we'll put the dividends less the equity issued. That's that one from above, net cash flow, and then we'll put how about target IRR on equity, which is our final thing, which is the up all the way up at the top. You have the target equity IRR, and this is really what they did give us. And then we can put NPV at target IRR, and that NPV you want to be 0. And then we can put goal. Okay, and then we're just going to make that NPV equal to 0 by changing this famous 20% that I put up here. Okay, so let's just model all this, and let's get all this done. So why don't we get the acquisition facility in here? And for the acquisition facility, that's a little bit tricky. There's kind of a little bit of tricks here. So first let's put an equals. The reason I'm doing this is you will have a shift control B, shift control R. You'll have a little bit of thing. Let's make the opening balance always equal the prior year closing balance. And this time we have the drawdown upstairs from our sources and uses of funds statement. And then after that, we've got a scheduled repayment that I'm going to leave out, but that's only going to be in year 5. And then for the cash sweep, we're going to get the cash sweep from way down here, and that's the big trick that's the second kind of trick. That's in line 142. Okay, and shift control W, and don't be worried about filling absolutely everything in now, because we've got a little bit of up and down to do it. Now I'm going to put a minus here and a minus here, and if you object to that, tough shit. And then let's put our opening balance times our interest rate that we did above here. And we could have kind of arranged it differently, but it really doesn't matter. I don't think they would ever kind of take anything away from this. Okay, and then so what we're gonna have some of the repayment come from the scheduled repayment at the end, and maybe for now, why don't we just do that? So the amount of repayment at the end, I did it backwards. And I need to put this here because we're going to take the opening balance. Let's put a bracket in here. We're going to take the opening balance minus any amount we've repaid from the sweep and multiply this by our little flag up here. And that will give us, so right now we've got just a fixed repayment, and then our interest goes away after that. And then for our refinancing facility, well, we need the EBITDA. So let's, and again, let's be a little transparent. You could argue that I'm not being totally perfectly transparent, but up here. And then because I'm not going to put all the flags right next to it, which maybe I should have done. Let's make our opening balance equal our prior year closing balance. I hope I did here. And the draw, let's get that from, again, our input page, which is, we put the refinancing facility at 5 times EBITDA, and let's take this thing, F4 times this thing, but times, this is where our investment in flags hopefully paid off, and we have a refinance period. And then now we can, let's do this. Let's leave out we don't have a cash sweep. Let's just take that away. Our opening balance is our original amount plus this minus this. Now, I hope this is going to work out okay, and I don't have a circular reference. The thing that I'm always worried about in just doing this basic stuff is getting a circular reference, but let's put our interest on this facility as the opening balance multiplied by the interest rate here. Okay, I'm still looking at the time. I'm very nervous. But up here, let's use our sum. Shift Control V. That's the total amount we have. Now, I hope that if I then make that one into our constant and put this, multiply this by our repayment percentage, okay, then we're repaying our facility and we have all the interest, and that's good that worked. And now let's just start filling in things. Let's go all the way up to our EBITDA. If you didn't compute the EBITDA, you'd be really have a problem, and that's only in our operating period. Everything now is just in the future. We got our depreciation up here. And let's multiply that by our operating period as well. Okay, I didn't, and now let's take the interest as this interest plus this interest. Okay, I hope there wasn't a bump anywhere. Yeah, well, there should have been a bump here. Let's, if keep the units the same so you can see them. And then we have some fees. Oh, shit. Let's do the fees later. Okay, I almost want to, because we're running out of time. Oh, God. And how in the hell would you do this in an hour and a half? What a bunch of shit. Really, these people, they're arrogant. They don't know. And I'm gonna quit with my labels just for a minute, okay? And then we take this one, and I'm gonna leave it as a negative tax. We say, okay, whatever. For some reason, we can pay negative taxes, which is really, you could put a maximum in there, but let's leave it for now, and let's put Shift Control W, okay? Another mistake they made, unless I have something that I've done wrong and I don't see what I've done wrong. Now let's go all the way up to the top and again get our EBITDA. If I don't know why that really matters to, no, let's get it from here. That's totally fine to get it from here, okay? And maybe somebody can write a comment. That will never happen on what I did wrong on my analysis times the yeah. I think if you've done this, you've already probably done better than any of these jerks that at this evil private equity company anyway. Okay. And then, and why you want to work there anyway? You say, I feel this. I'm too good for you. I don't really want to work for you anyway. Okay, and then we take our EBITDA minus our capex. I should have put them as minus. Maybe they'll ding us for that. Go to hell if they do. Okay, we're running out of time. So that's our operating cash flow, and then we can put our interest in separately. I guess that's because of the way I set it up. And we get our interest on our second facility. Okay, and then let's put our now repayment of our refinancing facility. Well, we have that. We put that up here. And then repayment of acquisition facility that we scheduled up here. Okay. And then we can get our new amount that we refinanced. I don't know what your philosophy is on all this adding and negative, but we can take our operating cash flow minus the interest on this, minus the interest on this, minus the repayment on this, minus the repayment, but plus this. So maybe I should have put pluses and minuses. I have this horrible habit of not doing that. Okay, and so we have our interest going on, and we have no repayments going on until we have this big repayment. And the good news is we're refinancing that facility, and then we have to pay the interest and the principal, and we're paying all that amount. And I don't know what happened here. Why did this? Why did we get a negative number? Oh, that's because we have this really big repayment in year 15, and we could make a comment that they should refinance this. Let's just leave it as negative number, but we should put it there. And then this is our cash flow before our sweep. So what you do is you take, and this is all, I should have Shift Control W. So maybe they made that 47% on purpose, and we're running out of time, so I'm not going to worry about it. Otherwise, I would say, we got to refinance that facility and all of that stuff, or maybe not make that same kind of, so we'd have to put a second refinancing in. But then I'm going to multiply this thing by the sweep, and that's what you want to kind of show off that you can do. So we're having no sweep, and then we get to 100% sweep. Now, if you do that, whoops, that's hang on. It's this number multiplied by our percentage. And it was certainly 0 at first. Okay. That's okay. And then this is our sweep. But look, we got a negative number here, and that's because we paid off too much. And so what you have to do is have this be the minimum of this number, and the good news is they didn't have any scheduled repayment, so they didn't make it way too difficult. You have this or this number, okay? And now what happens is we don't have any scheduled refinancing. It all comes from the cash sweep. And that means we can take this net cash flow, subtract this one, and the one thing I did not do is I forgot to do this, and in the debt balance on this, oh no, I did. I put the cash sweep. It comes from down there, and we paid off our closing balance, and you're supposed to kind of, if you really had a lot of time, you'd put the sweep in there. And I just can't believe these people. The time stuff on this is just kind of ridiculous. And then we get now this cash flow after the sweep is our dividends. That's what we get back. But when we do our equity cash flow, we get these dividends back, and then we have the equity we issued up here in the up here, this equity issue, okay? And then you can get your net cash flow, which is this minus that. Oops. And then, what I think we should do is we should then go down here and put a equity IRR. Now, I predict it's going to be way too high because of the way we did the other thing. Let's put equal IRR, and it's all annual, so there's no big trick with XIRR or anything else. And we got way, way too high, so we paid way too, we can pay a lot less. And so we can do the NPV at the target IRR. That's the whole trick. And you do this, and the NPV is going to be really big, a big positive number. And then you do a goal seek, and you do a data, and you do a what if analysis and a goal seek, and you set this number to 0 by changing that number that we didn't know what to do with up here, which was our 20, no, where was that? Our project IRR. Uh-oh. Oh, shoot. Oh, come on. What? That shouldn't have been any circular. That looks like there was a circular reference. Let's just, this one depends on that. And if I put, let's go up here and put equity IRR. And now I'm really showing you how difficult this stuff is, maybe, because if there was no time problem, I would do a pause on the video and just show you how to do it. But and I've only got 10 minutes, and we've got to do all our silly little graphs. Oh, well, again, I'm not going to make it, but this time I'm going to keep going. Okay, so let's put our sources and uses here. And if I change this to 10%, okay, then I have a whole lot of new equity, and this went down. So, and if I want to change, if I put 11% in here, and I guess I'm just going to assume that it's mainly equity, 11.5%. I don't know what to do. Maybe we made some mistake here, because it certainly doesn't make sense that this is so low, or maybe I changed some assumption. You know what I should do is change the assumption and pretend that this case didn't have 4 million in just a second. What was our what was our 3.5 million tons? So I might have just changed. Let's put this back to 3.5 million tons. Okay, and now what I'm going to do is I think what I'm going to do is just if I take a little bit of time more, I'm sorry, I failed the test as usual. Good, you can see that I'm really not very good at this stuff, maybe because we didn't put the amortization of fees in here either. But now, if I do this, if I just, I certainly, the one thing I would not do is I absolutely can't do that, is to do a goal seek on the IRR. You do a goal seek on the NPV, you make it equal to 0, and you go up and you change the project IRR. Oh, great. Save your work. And there's something crazy going on. Okay, what I'm going to have to do is find my mistake now. Well, but how about this? Right now, we're getting close. 11.4%. Let's just do 11%. What did I do wrong? I did something really in an idiotic way. When this equity IRR is this, this is the NPV at the equity IRR. And do I have any negative cash flow? Maybe this negative cash flow is causing a problem with the NPV. It couldn't be really. Okay. Let's do this. Control-Alt-C. Let's make our up to line 9. Let's make it a top color, and let's color the whole sheet. Okay? Can't do anything else. We might as well color the whole sheet. And even though that wonderful, and it's taking a little bit of time, I swear it shouldn't be anywhere near 8 seconds here. It really should be much faster, and there we go. Okay, and it's going to show us what's an input, what's and it's going down through the rows, and at least we're going to get that. And I've got 5 minutes, and for the output, we can put up here our, I don't know why we do this, we can put a little cash flow statement, but that's a waste. What we could do is just start copying this cash flow statement, or worse yet, we could move this cash flow statement somewhere into the other sheet. But instead, they also asked us to, let's see, let's go one by one. One by one, and we did that. Let's put our EV to equity bridge. The sources and uses we can take directly from there. How about this? So let's do our EV to equity bridge. And let's put our value, and I suppose we can put it in the transaction period. And we put our enterprise value, and what you do is then you take away the net debt. Maybe I added something instead of subtracting it. Now, the amount of equity we actually pay, it's really, I would take away less. Let's put acquisition, add repaid debt, and less, I would put less the fees, and then we can put our equity value, equity. And basically it's exactly the same as the other one. Maybe I'll find my mistake. So let's put a minus on that this time. And we don't, because now our debt that we, our existing debt wasn't there. And let's put a minus on the fees that we have to pay, these debt fees and these advisory fees. It looks like I really am just struggling with this. So this is something like it. And how about then we can put our sources and uses in here. So I've only got 2 minutes. I'm really screwing up. Let's put our, they wanted sources first. Fine, who cares? And get that debt and equity from our sources and uses. This is, for me, all a complete waste of time. And okay, these people never shut up with their stupid crap. Okay, and then let's put the uses. Okay, and I'm just going to go over time, and I'm not going to care. I don't see how you could have done this. These people really are evil. To make you stress out like this, and to make something that I think I'm using all my cheating and I still can't get it done. And okay, so we have that done, and now let's see what else they wanted. Okay, we've done that. Calculate the annual equity yield. And why don't we, sensitivity. Oh, shit. They kind of, you'd have to do a data table and put different multiples in and showing the EV-based output EV based on variable input IRR and exit multiple. Well, let's do it like this, because maybe the whole thing was to do this. You cannot do the data table here, really. You'd have to bring it over. So let's just, since we're running out of time, let's go over here and put our sensitivity table, and we'll put the terminal value. I just hate this, by the way. And let's start with 8. How about we'll put 8 and we'll put plus 0.5. I've just ran out of time, and then let's put our project IRR. Let's do it with that one because we did the goal seek on that. So let's do 10% plus 0.5% and do this. Shift Control P, Shift Control P, Shift Control Q, and put our enterprise value. Is that what they wanted? I think they wanted the enterprise value here. Okay. And by the way, you can get this case if you send me an email. Oh shoot, I gotta put it on the library. I'll do that, but whatever. Sensitivity based on the exit multiple and the IRR and the EV. Okay, fine. We couldn't do it. If they really would want it on the equity, it wouldn't work. So you go up in between here and find the enterprise value. And that was the one we were having all sorts of trouble with. And what I'm going to do at the end of this video in just a minute, I'm going to see if I can figure out why we're getting these funny enterprise values relative to the equity value, and why that goal seek didn't work. And I'm really struggling right now. Okay, oops, I didn't want this. I'm gonna have to fix this. See, I really do worry too much about the coloring, but you're an idiot if you, or we could even put did they want EV to EBITDA or just enterprise value? Output EV. Okay, fine. Okay, so they want something like this to show you can do a data table, and you select the area and put data, what if analysis, data table, and let's put the row input cell as this input of the IRR that we did, and the column input cell. It'll work fine, I think, with this, I hope, as our terminal value. Is that right? I think I did it right. And then it slows everything down, and I have to press Shift F9. Uh-oh. Paused it. Just let me see. Okay. Okay, I didn't mean to do that. Okay, I'm making an addendum to this. First, let's talk about the EBITDA and the EV to EBITDA and all that. If you assume revenues are growing in real terms, I've changed this. Now we have no revenue growth, and expenses are declining in real terms. You're going to get a very high hockey stick. If you play ice hockey stick, when you put the hockey stick on the ground and it goes up and all that, you're going to get a very high EBITDA, and that EBITDA is what we should have graphed. And the present value of that EBITDA is going to be very, very high compared to the current EBITDA. And the current EBITDA is what you use to compute the debt to EBITDA. So the debt is going to be very low. I'm sorry. It was a crazy, idiotic assumption. So I changed that. Now, after I changed that, I also struggled with the terminal value. Now, here is what I did that was so incredibly bad. I had a circular reference in there, and because I was just messing around with something else, and I had my options and formulas and iteration on, and there was a circular reference that I didn't catch, and that was messing everything up. Oh my gosh. So now I made a little fixed EV to EBITDA, or we can use our thing here, the present value of the net cash flow. Well, I put it in here, or this enterprise value. Let's we're using this enterprise value. Let's do the same thing. So now when I do this, now this is all messed up. I've got an IRR of 150% because I changed everything. But let's do that. So right now we have a gigantic debt compared to the equity. So let's go and fix this. So when you get to the very end, the idea is you put an NPV at 11%. We don't want this 150%. We can even make a macro around it if you had time, but I'm not going to do it. Let's just do a goal seek and set that NPV equal to 0 by changing the project IRR. Let's see if that works still. Shoot. Oh crap. I'm gonna have to do it the way I changed too much. Let me do it one more time, and I'm gonna start screaming, and I'm not turning off the video even. I'm gonna make this NPV equal to 0 by changing our fixed EV. So we could have done it with that instead. So I made this one a fixed one, and please work. Ah, look, it worked. Finally, it worked. And now, these people, and now, well, we've got almost too much debt. Okay, let's grow the revenue per ton in 0.5%. How's that? So our O&M expenses are going real, and now let's practice it one more time. I'm so sorry about that, and whatever. I'm not that sorry. You can turn the video off after all. Let's do the same thing. Let's go data, what if analysis, and this shows you why you should make a macro around a goal seek almost every time. And it shows you why a goal seek is important, and it really illustrates for me this dramatic problem of allowing the iteration button to be on. Okay. Good. Okay. Oh, look how sensitive it was. So now we have some equity issuance. Now the problem I had was with this little cash sweep. I had made the repayment before the cash sweep, but this repayment down here in the that schedule was after the cash sweep. So blah, 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 down here in our cash flow analysis, I put the repayment, which was 0 anyway. it was 0 anyway. And I did one other thing. I changed the input. So now we really did have it as a 15-year debt, and I just extended the input so we could fix that in the model. So they should have given us a couple of extra hours, and now I'm going to waste my time on something absolutely absurd, which is to put down here. Let's put how about down here? Let's go to this debt balance, and then put our fees, and the fees we have here are this, and then let's put our amortization rate with a percentage. Okay, so let's, the fees are on the first, that we've got debt fees here. The advisory fees don't get amortized. They get, what do they do with those anymore? They were part of goodwill. I can't remember. The accounting people go nuts on this shit. Let's just put those first debt fees here. And how about I'll do it kind of like the depreciation. We'll fix that. And then we'll waste our time by saying, okay, I'm gonna, our tenor was 5. And we're going to take this one, and we're going to take 1 divided by this one and multiply that one by the repayment flag for the first facility here. And I hope I used the right 5. Did I use this? Control square bracket. No, I didn't. I meant to use the repayment period up here. Okay, and shift control P, shift control R. Uh-oh, and we should have locked that. Whoops. I'm really losing it now. I swear I pressed F4. Okay. And then again, just to review, use the sum. Okay, and so we can have a fee amortization. The fact that they wasted your time by asking you to do this is just incredible, because these people care so much about fees, I guess. That's really the answer. Oh, God. I understand if you have a real model that you want to do that and all that, but, let's make sure we get the fees. They're almost like they're, whatever. I was going to say something inappropriate. And then let's do the same thing down here. Let's put a couple of extra lines, shift control plus. Let's copy these ones down. And I didn't put the fees in the cash flow on this one either. Oh my gosh, what a mistake! Oh no! Oh no! Okay, whatever. So our fees are, we had our fee assumption up here, and we're going to take the fee and multiply this by the amount of debt we issue. Let's do it like that. Why not? Okay. Oh, no, because we need this in the cash flow. Let's put it in the cash flow, because that's the more important mistake that I made. How could they expect you to do this crap in one period? So after that, maybe we'll put it up here, less arrangement fees. And again, I said again, it's not really again, but we would do this kind of the transaction period is separate, and then we better put a minus on this, and we would get yelled at for not making it minus and a plus. So you do this correctly. Since I used the word do, it's an adverb, not correct. Correctly. If I correct people around here and then I get screamed at, what's the matter with that? I can't. My English isn't very good either. I hope my other, whatever. So let's put a basis of amortization. I've used the S before, this time I use this one, and let's do this kind of trick, Shift Control V, and a lot of people would say, oh, you can't do that. Of course you can. Okay, I'm just formatting it a little bit. And then, so we just put the, we can, I'm just going to flatten this. Oh no, I'll multiply it by over the repayment period. And that, getting that repayment period was a big deal. I mean, I just can't. Some of these cases, what do they want? Did I hope I did this. So there's our base for our amortization. And then our amortization rate will be, we'll put the debt tenor. I'll put 1 divided by I'll just go upstairs and find now I changed that to 15 years and then change the repayment period to make it work a little bit better. So let's put this, let's multiply this by we don't really have to, but let's go ahead and multiply it by our big deal, which was our repayment flag. And to get a repayment flag is a big deal. Whoops, my other computer just fell down. And that's the one that actually kind of works. Amortization rate times the base. Okay? And then it would be a good idea to put this in here. And did I do the fee amortization here? Yeah, I hope I did. So this equals that. If you're real fancy and had time, you'd even put a little check for this in. And then we can put in our fee amortization because we have this one plus this one. And if you wasted a lot of time on this, that just wasted a good portion of our time doing that, we wouldn't have been able to do the graphs and everything else. And I think we're okay now. I think what happened is when I made the data table, because of I pressed F9 and that switched off the thing. I can't remember if I made the graphs with you, but the trick is just to leave this blank, put a thing here, and then this DSCR is what, this is crazy. Just press F11. I don't know what happened in year 5, this special period. Maybe we'd have to look at that again. If you don't like that DSCR, well, let's just do this first. Let's move the chart and move it to an object in there. So the trick is to just put that 1 year in there, and do that quickly, and then I don't know what happened here. Now it looks a little more reasonable, and I would click on this and add the data labels maybe, and if they're too big, you just go to the home thing and I can't remember if I did. Let's put 7 or something, maybe 6. How's that? Okay. So what happened here? Maybe I put the repayment. Well, we put the repayment from that sweep in there. That's the problem. You had a big repayment, and I don't know what was 155. Let's just do the DSCR without the sweep. Who knows? You can't really compute a DSCR with a sweep, so it's another idiotic thing these jerks did. Okay, and then, the total debt balance went down to below zero. And why did that happen? Let's just go up here. Oh no, we have a refinancing facility, and I, on this repayment percentage, where that's what I'm going to look for. We go up a little bit higher, and I put an extra 109 there, so that was I did that on purpose, So let's just delete that last one. We're kind of getting it done, okay? And again, now we have 11.04 because I put that in. So let's just practice doing this one more time. Let's go to data and what if analysis, goal seek. I don't know if you would do this. I would love it if you could tell me I've done something wrong and come up with some other ideas on this one. Or maybe you say, "Oh, don't use your generic macros, you idiot." Okay, but then we can get that. So it turned out that the overall project IRR, or if you want to do some whack kind of crap, is actually higher. That's bizarre. Why did we need a higher? We should have had a positive trading on the equity, and I put in the terminal value. Okay, I'm not even going to worry about that right now. We have a bigger equity issue. How about this? We have too big an equity issue. Let's do one more thing. Let's put 0 in for this growth, and how about 0.2% in for this one? So then again, what we have now is the whole thing doesn't work. We need to redo our target IRR one more time. Okay, and I almost am hitting myself for not doing a macro, but again, this is a test, so I guess you wouldn't want to do it. And so we're doing this, a goal seek, and we're changing our enterprise value. All right. There were aspects of this case that I kind of liked. Let's see what our sources and uses are. Our enterprise value is this. Total uses. I'm not even looking at the financing. Ooh, the equity is still a little high. Okay, whatever. I don't think I did anything wrong, but if you tell me I've done something wrong, I'd be really interested in this. Okay, and we have the equity consideration here, and I've done something wrong with this minus this 5. So I should have. It looks like it's this. What's this times 2? Yes. So on this one, I should have put this one as whoops. Oh, come on. Now, where are the advisory fees we had to put in? Screw it. You figure that one out. It should have been the same. And then they wanted you to put a summary cash flow statement, and I just can't do that. We have a nice little cash flow statement here. Okay, and we needed it here to do their cash sweep and everything else. So screw them. And then that was just criminal to even ask for. Okay, you can of course redo it and relink it, and I think you shouldn't. I think please do something good in your life instead of that. I wonder how asinine these people are, these private equity things. Okay, that's enough of me moaning. I think I'm gonna stop.